From our point of view, I struggle to see how, from our own point of view, how to make investments outside Poland and Czech in the short term. I think like everybody else in 2006, 2007, I was running around Romania and Bulgaria, just thinking, wow, I've got to invest in these places, but the yields just went, as Walter said, just went crazy. Beside the things of political risk and all this, they all add up into a very simple thing from my point of view, which is liquidity. We're a closed-end fund, so the only thing I know before I buy something is I have to sell it. So when I do an underwriting model, I have to put some time frame on when I'm going to sell, and I have to put some level of exit yield. And places like Romania and Bulgaria, from my point of view, I can't do that. That's the same currently for in Italy or in Portugal. So it's not like those countries are separate from everywhere else in Europe. They have, that characteristic is very similar. So why is the investment market dried up in Spain, for example? It's to do with pricing, it's to do with liquidity, it's to do with availability of stock. And I don't think Romania and Bulgaria are particularly different from that. And Hungary is the same for us. You can, from my point of view, you could probably buy a prime office 100 basis points cheaper in Budapest than you could in Warsaw.
That's 200.
But I think your financing costs are going to eat most of that difference in yield away, and then you have the risk of leasing that building, or releasing it, shall I say, and then you have the risk of exiting. And I think those risks are risks that we don't particularly want to take at this stage. I'm very hopeful that as Europe recovers, those economies will present opportunities, because I don't think the investment market in Europe can really continue into perpetuity investing in 5 dominant markets. You need a wider investment pool for Europe to really take the next 10 years, and I'm sure that will change. But at the moment, I don't see in the next 12, 24 months how those political situations, economic situations will change so significantly that the big risks that are unknowns, I will be able to underwrite.
I think the time frame is a very crucial point here, Daniel. I personally would think that if you take Budapest, for example, if you have the time to wait, if you buy today at, 8.5%, 9% for very good office buildings, you can probably get 1 or 2 of the top 10 office buildings in Budapest for that sort of yield. And you've got rental levels that are at a historical low of 12, 13 euros. So arguably there should be rental growth and there should be cap rate compression over time. But I completely agree. If you know that you have a 5-year window, it may not happen inside 5 years. But if I had to make a guess about where to invest in the long run, I think Budapest is probably not to be completely underestimated. And the other place I'd look at, even if I've called it a bet before because I can't lend there, is Moscow. I still think that there are compelling opportunities in Moscow for the sheer size of it.
The investors are mainly focused on the prime markets, the core markets, where they're confident and comfortable with those markets. And that, again, as we've heard mostly through today, if it's offices, it's Warsaw, and it's Prague, it's capital cities. The prime product and the core investors are driving the market, and it's the equity play which is important. The debt is reduced. I can't see those other markets providing those opportunities.
So from your end, if you're an equity player, if you're an old equity player, you can probably buy something like that for 11, 12%. And I think there are people who are looking at that. But that's pure equity, that's unleveraged.
Yeah. We're soon to bring a portfolio of retail to the market, which has some highly opportunistic angles to it, because one of the schemes, a major scheme, is held on it's got 20 years unexpired leasehold interest. Now, there's a huge fear factor to that, but it's quite likely, it's not guaranteed, quite likely that would get renewed or extended. And the yield is could be even north of 9%. It's a €200 million portfolio, 5 shopping centres in the major cities of Poland. It does have this leasehold factor, but if an equity player can take a view on that, is happy with the leasing risk and the chance of getting it extended, it's a fantastic opportunity, because you're roughly 300 basis points north of prime.